Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, what we're going to talk about is when we think the Bank of Canada is going to increase its interest rates, if they're going to be increasing interest rates, and what it means for you if you have a variable rate mortgage. So stay tuned, we're going to dive right in. Once again, thank you to everybody for tuning in and for all the wonderful feedback we're getting. We really appreciate it, and we're going to continue to do these Finance Fridays videos and continue our financial literacy journey to help educate and create a little bit more awareness around the mortgage and real estate industry for a lot of those first-time home buyers, for a lot of the existing home buyers. So we just want to get that information out there. In this video, we're going to be talking a little bit about our opinions, so the information that we're conveying should not be misconstrued for financial advice, and that you should make a decision. Each unique individual, each case is unique, so you do need to speak with your mortgage professional, real estate agent, or accountant or lawyer in anything that we discuss. So we just want to enter that caveat into there. So in this video, what I want to really talk about is where we see the Bank of Canada going when it comes to interest rate policies and increasing interest rates, and what are some of the things that we need to pay attention to. And one of the most important things that we're seeing right now in the news is inflation being at an 18-year high. And obviously that is something that is alarming for many Canadians. But it all depends on how you look at the situation. So the issues that we're seeing right now is because of a shortage in getting the supplies to the shelves or getting it to the consumers. It's not that there's an immense demand for these items necessarily. It's literally that they're just not able to produce them because there has been some supply issues with getting these ships to port, getting all this stuff to the shelves and to the stores so that you can purchase them. So in essence, once we can remedy getting all these ships to port, I believe personally that the inflationary thing, the items that we're seeing right now with the causes and the concerns for inflation are going to sort of subside. So that is number one, because if you look at it, the Bank of Canada and any central bank cannot just print more ships and get all these items to the shelves. They need the manufacturers. Obviously, we ran into the issue a while back with the Evergrande, basically, causing some major issues over the period of time that we've seen, and obviously that's snowballed. So once we can remedy that, I think things will start to level off. And I do believe, and I am the belief, that inflation at this current moment is a little transitory. Yes, we're running at an all-time high 4.4% CPI index, which is very alarming, but I do believe it is, in essence, something that is transitory. Number two, when you think about the Bank of Canada and their decisions, we have to consider all things, right? The Bank of Canada is just one small piece of the global economy. We have to turn to the U.S. Federal Reserve, Jerome Powell, and look to see what the U.S. is going to do, as they are the leaders and basically the world currency is in US dollars. So we need to lean a little bit more and see exactly what the US Federal Reserve is going to do. Not necessarily that Tiff Macklem is going to come out and make changes, but every decision that they make, all the heads of central banks have conversations in order to create monetary policy and to hopefully grow the economy. The idea is that we want to create growth. And by increasing interest rates too early, you're going to stifle growth. And that is one thing that I believe very firmly in. The Bank of Canada, as well as all the other central banks, need to really be cautious of that, because although, we see things coming, reopening, we're starting to, here in Canada, start to have a little bit more guidance in regards to what's happening in the new year. We still have to be very aware that a lot of people have left their jobs. There is a lot of shortage in the labor force, and that needs to be remedied first and foremost in order for things to normalize. So when you look at all these things in combination, we have to understand that if the Bank of Canada was to increase its interest rates prematurely, and that would cause a ripple effect for businesses, because businesses are not going to be able to borrow. They're going to be having to service higher debt payments, which means they're not going to be able to inject more money into their business, not going to be able to hire, and not be able to put more money into research and development to help grow their business. They're going to focus more on trying to service the debt. And as many Canadians right now who are also household indebted due to mortgages and purchasing real estate, maybe some people have purchased real estate that's a little bit stretched out for them. Maybe they haven't. They've looked at their variable rate mortgage and they said, hey, we can take on more for less. And I'm not saying that there's anything wrong with that, but what we need to do is a lot of Canadians and a huge proponent or huge percentage of our clients are leaning towards the variable rate mortgage because of the fact that it is a huge spread in between the two fixed and the variable. So currently, at the time of filming this video, you're looking at fixed rates that are sitting and hovering around the 2.2 to 2.4%, and variables sitting from 1.2 to 1.4%. And as you can see, that is literally a 1% spread between the two rates. So for a lot of Canadians, they're looking at that 1% difference and saying, hey, it is a substantial amount of difference and a lot of savings. So what if you own, or if you're in a variable rate mortgage? How can you plan for increased interest rates if the Bank of Canada increases it? One thing that we say, if the Bank of Canada does increase its rates, is not to panic. Because if you're 1% lower in your payment, and let's say the Bank of Canada increases its payment or its interest policies 4 times, 5 times, you have to look at the rate, what the bank decides to do, and how they decide to change that rate. If it's going to go up 0.25%, if it's going to go up half a percent, and you need to consider where you are in opposed to the fixed rate. So we do have a lot of runway ahead of us in regards to when they're anticipating raising the rates. They're projecting into 2022, maybe into 2023. But as I've stated earlier, you have to be very cautious because this is a fluid timeline. There's no necessarily set time. We have to look at the global economy. We have to look at what's happening, and any specific change, let's say they do raise the interest rates and the economy doesn't react well to it, there's always going to be something that changes it. In the past, when Banks of Canada and central banks have raised interest rates, there's been some crises that happen which caused them to put the rates back down. So not to panic if you're in a variable rate mortgage and you're hearing all this news about what's happening right now. Think about the dollar cost average that you're saving on your mortgage as opposed to being in a fixed rate mortgage. And one piece of advice that we can give to clients that are worried a little bit about the interest rates and not sure whether they should lock in or not, I would say look at your finances first of all, speak to your mortgage professional, and number 3 is, if you really want to offset any potential raise in rates, is to increase your payments to put more money towards principal, right? Now, it all depends on the product that you're with, the bank that you're with, and each bank may change their policy rates and their interest rates, which are reflective in your mortgage payments, at any given time when the changes happen. So you do need to be aware that it has to happen first. We need to be very cautious of what's happening, but I want to basically just convey this message to our viewers is there's a lot of stuff that the banks need to consider, the Bank of Canada, the central banks, and those people that make monetary policy. I do believe that there is a discussion happening right now, and as I said, everything that we're discussing in this video is an opinion. It is not to be misconstrued or taken as financial advice to select a variable over a fixed or a fixed over a variable. That is a decision that you need to make when you're purchasing your home, having that conversation with your mortgage professional and looking at the numbers in front of you. All depends on the size of the mortgage, depends on your appetite to risk, and it all depends on what you're doing with that property if you want to get out of that mortgage sooner. Because when that, let's say for example, people that are in their 5-year fixed right now, and maybe they got 2 years left and the rates will change in 2 years, maybe we're going to see some good 1 to 2 year fixed rates. Maybe we're going to see some good 3 years. Maybe we're going to see some additional fixed rates come down as the bond market changes. So you do need to keep in mind that if you're in a variable rate mortgage, you can lock into a fixed at any time, whatever there's being offered by your institution. But if you're in a fixed, you can't go into a variable. So I hope this video is helpful. I hope we've answered some of your questions and fears and concerns that you may have in regards to the Bank of Canada and, are they going to be changing rates and what they need to consider, as well as what it means for you if you have a variable rate mortgage. It's Friday. Thank you again for tuning in and have a great weekend ahead.